Good morning, students. Hope you are all doing well. Today, our topic is internal rate of return. This is another discounted cash flow technique of capital busting. This method is also known as hit and trial and error method. As here we are just using or trying various rates to find internal rate of return. Internal rate of return may be defined as rate of return at which present value of cash inflow is equal to present value of cash outflow. Means here basically NPV is equal to 0. There are two type of cases under which internal rate of return is calculated. The first case we will discuss here, that is where cash flows are even, equal or same for all years. Let's take an example. A project cost rupees 50,000 which generates cash flows of rupees 12,500 for every year for 5 years, because the life is 5 years. Calculate internal rate of return. So how we can calculate internal rate of return where cash flows are equal? So here present value factor, which is equal to capital outlay, means cost of investment divided by annual cash flows, that is equal to 50,000 rupees divided by 12,500 rupees, which is equal to 4. That 4 is equal to present value factor. How we can utilize that 4 into the internal rate of return? By applying the above formula, we get to know that the value of present value factor under annuity table for rupee 1 or compounded table for rupee 1 against the life of a project, which is equal into 5 years. So this is example of annuity table, means how annuity table looks like. That is basically on the left hand side, years are given. On the top of the table you may see that is rates. If we can check into the annuity table or compounding table, the rate against the 5 years, if we can check 4 into the present value factor table, that is equal to 3.99 at 8% and 4.15 at 9%. So we can pick 3.99 as the value. So internal rate of return is equal to 8%. So the second case, when cash flows are uneven or unequal or not same, here we have to apply the different rates at which NPV is equal to 0. Means we know that NPV, how we can find NPV, that we have discussed in the previous lecture. NPV is equal to present value of cash inflow and difference between the present value of cash inflow and present value of cash outflow. Let's take an example. If the project cost me rupees 61,000 and it generates the following profits, that are profit after tax before depreciation. We know that the cash flows are equal to profits after tax before depreciation that are given for 5 years, that is 30,000, 20,000, 5,000, 10,000 and 20,000. So how we can calculate internal rate of return? As we know that internal rate of return is also known as a trial and error method or hit and trial method. So here we are try for the different rates. So as to get NPV is equal to 0. So here we are applying 10% present value factor. In the previous lecture we have discussed how we can find the present value factor under a 10% discount rate. So if we can multiply the 10% present value factor along with the cash flows, then the present value at 10% cash flows are equal to 66,795. If we can check NPV here, that is 5,795. So we have to apply for the higher rate so as to get a lower value. Present value factor at 15%, if we can check the present value of cash inflows, that is equal to 60,390, and at 14% if we can apply so as to get a 61,000 as a cost of the project. So here at 14%, present value of cash inflow is equal to 61,365. Here we get 365 as excess to the cost of the project. So we have to find in between value between the 14% and 15%. So we will apply internal rate of return is equal to lower rate plus NPV at a lower rate divided by NPV at lower rate minus NPV at higher rate multiplied by difference in the rates. So if we can find by this formula, the value is 14.37. 14.37 is basically an internal rate of return at which the value of NPV is equal to 0. So next we will discuss a difference between the internal rate of return and NPV. That is, in short, I have given there are basically 6 differences between NPV and IRR. We know that NPV should be calculated in the absolute value, that is should be calculated in rupees, but internal rate of return is calculated in percentage. Decision criteria: if we can talk about decision criteria, NPV should be accepted the project if NPV is positive. Internal rate of return, if we can internal rate of return is above the discount rate, then we will accept that project. Then discount rate changes, third point. Impact: it will impact the NPV, but it does not impact in internal rate of return. Adopted by: NPV should be adopted by the large scale businesses, but IRR should be adopted by small scale businesses. Reinvestments in NPV that do not matter to the NPV, but if we are talking about internal rate of return, it is relies on the reinvestment assumption at the same rate as IRR. Cash flow patterns: positive or negative, that will work in NPV, but that has not impact on IRR. Thank you so much. If you have any query, please send me a comment on that video. Thank you.